panel session is Future Proofing Your Investments. The speaker is Mr. Sandeep Jethwani, Senior Managing Partner and Head of IFL One and Head IFL Wealth Management. He's part of the founding team at IFL Wealth.
Hi, good evening, everyone. I'm Sandeep Jethwani, and I'm privileged to speak yet again at Ascent. It's been a great experience working with Ascent for the last many years and seeing it grow from strength to strength, much like the entrepreneurs that Ascent supports. I've been working with entrepreneurs for the last 15 years in trying to understand how they build businesses and how they successfully manage portfolios or investments afterwards. And it's no surprise that one has a lot of admiration and respect for what all of you guys are building here. It's an interesting journey. It's a hard journey. And we come in as wealth managers, as partners much later in the journey. Today, I'm going to be talking about how to future-proof your investments. And as I was thinking about this, future-proofing is nothing but retaining the value of your money or staying wealthy. When I was thinking about it, I thought that let me actually put this into a real context. And rather than talking about in abstract terms, in stuff like technical jargon around this, I thought why not contrast this, the process of managing your money, with the entire journey that you have as an entrepreneur, and why that journey is very unique and very different. Often as entrepreneurs, we are told that we have to stay hungry and stay foolish to get successful. This is a very famous quote by none other than Steve Jobs, who said that entrepreneurship requires a sense of craziness. Sometimes you have to do stuff which the rest of the world feels it's downright silly or absolutely out there. When it comes to investing, it's actually quite the contrary. And this is the message that I want to leave you with today, is that investing and entrepreneurship are potentially two opposite ends of the spectrum. And the challenge for some of you guys, and as I've seen even for some of us, has been to bridge this gap or journey. What gets you to a point of being rich or wealthy, and what you need to stay wealthy are often two very, very different things. So let's dig into that a little bit. But before that, let's try and understand what staying rich really means, And at some level, this is a philosophical point. This is also a very important point that you have to look at when you start managing your portfolio or investments. Because whatever you're doing around your portfolio actually needs to be oriented towards what is the goal that we have for that money. Is my goal beating inflation or simply retaining the value of money? So if I'm buying a certain set of things with 100 rupees today, I should be able to buy the same set of things with what is the value of the 100 rupees, say 10 years from now. It could be meeting my aspirations. I might want to have a bigger house. I might want to have a yacht or an airplane, or it might be different things for different people, right? So identifying those aspirations and planning for that is very, very important. For a lot of entrepreneurs, and this is from personal experience, they realize that they're taking risk in their own businesses. And to that extent, therefore, one of the important things that they want to work towards is securing the future of their family. I would think that majority of the mandates that we manage are oriented around this one aspect. That said, for each one of us, the objective of staying rich or keeping the value of our money is different. I would strongly encourage, whenever you get time on a weekend, to just put down those 2 or 3 things that you think you're really planning for, which can potentially help you and help your wealth managers or your advisors work with you much better. So now let's dig into what are the differences that I was talking about. What are the big points that we need to be aware of as entrepreneurs when we manage our portfolios? Again, this is not gospel truth. These are some of the learnings that I've had over the last many years. And more importantly, very happy to learn from all of you. So at any point, if you feel the need, do pop in a question or tell me more about what you think on this matter. Let me start with the first aspect, which is what we call diversification. Now, as entrepreneurs, some of you have heard this phrase of going all in. Going all in essentially means putting your 110% into that one objective or one goal that you're chasing as an entrepreneur. When it comes, however, to investing, it's exactly the opposite. Investing requires us to spread out money, spread out investments across different buckets. So it can be different asset classes, different mutual funds or investments within those asset classes and different individual instruments. Very rarely would you hear a good wealth manager tell you that this is the one thing that you need to do to stay wealthy. Most of us don't know. And if the last 10, 12 years have been any evidence, the learning has been that you need to have different pockets of money allocated to different instruments. This is something that came up very recently in 2018 when the IL&FS crisis happened. If you rewind back, IL&FS seemed in early 2017 or early, even as late as mid 2018, like some sort of a quasi-sovereign entity, AAA rated. And naturally, a lot of investors that we hear about through media, etc., had a lot of their investments in bonds of IL&FS and so on. Now, even for something which seems as safe as that, our recommendation would be not to have all the eggs in one basket. You need to diversify and look at, even within the highest quality, spreading out risk in different instruments. We saw this again in the Yes Bank perpetual matter, where these perpetual bonds were written off. Again, a very, very difficult situation for retail investors. And this is the one message that has come across very, very strongly, that we need to allocate money across different pools of instruments at different points of time. You will again hear this when it comes to things like mutual funds also. Sometimes there is a tendency to back or put all of one's money in the best performing mutual fund, and which is natural. You look at the data, you look at the size of the fund and say that, look, potentially this fund has done so well over a sustained period of time. Why don't I put most of my money there? Why do I want to do other things and so on? And it's a completely logical thought, but there are changes that happen. There are instruments that don't work in certain periods of time, and having allocations to different instruments really makes sense. For instance, if you look at the last many years, there are times when equities has done really well. Gold has done well, in fact, for a very long period of time recently. And so has fixed income when markets have fallen. So having allocations across these buckets has been really helpful for investors. The other part, which is again a big difference when it comes to investing versus entrepreneurship, is this whole thing of chaos and versus discipline. As entrepreneurs, you guys embrace chaos. You're in a situation where you open up seeing crazy opportunities or crazy dislocations in the market, at which point you would jump in and take benefit or take advantage of that. So one of the best companies that have survived and done really well have been companies which have taken advantage of chaotic situations and built that to their own benefit. When it comes to investing, it's sometimes quite the contrary, actually. Again, here, we would want all of you guys to think about a short half a page document, which we call the investment policy for any portfolio. These are the rules that you basically live by when it comes to your portfolio. What I will do, what I will not do in my portfolio. For instance, there are a lot of people who say that I will not leverage or do futures and options trading in my portfolio. And that's fine, because that is the rule that they build for themselves to be able to ensure that they don't react badly when things go off. And that's where successful investors like Warren Buffett and Charlie Munger have done really well. You will hear from all of these very successful investors the kind of rules that they have built and do's and don'ts that they will have for their own portfolios. So if there is one thing or one document that you would prepare when you think about your portfolio, we would strongly suggest to think about building an investment policy. And it doesn't have to be a very complex document. It should say simple things like, what is the asset allocation, or what kind of equity debt breakup will you have for your portfolio? Within equity, what will you not do? For instance, you may not want to do trading in futures and options. Within debt, what kind of investments will you not invest in, which is maybe lower quality bonds and stuff like that. So these are very simple things that if you can just put together, it can really help. And again, something that is very different from an entrepreneur. As an entrepreneur, I can never say that this is the one thing I'm going to do and not do, right? You're reacting to every situation on a daily basis in a very unique fashion. The other thing that when it comes to investing is again this tendency of quick reactions. And nothing sort of puts this in better context as FY20 or the year 2021, when we had all this COVID situation play out. We had crazy upheavals in the market. Let's rewind back and go back to the month of March, when COVID was at its peak. Imagine the kind of news, media, information, WhatsApp messages, emails that were being thrown at us. There was everything that is negative. Nobody knew how the world will react to this, how our own business that we are running will react to the COVID situation, or for that matter, how countries will react. And at that point, it would be natural to make the first quick reaction, which is to get out of equities. Okay. If you tell any sane investor that what would you want to do if a time like this happens, that investor would say, why don't I take my brakes off the pedal, or my put brakes on investing journey, pause for a minute and not do anything. But again, it's important to remember that that is also a quick reaction. In investing, sometimes you're more a lab scientist who's sort of testing everything on a daily basis, thinking about everything before reacting, as opposed to as an entrepreneur when you're like a goalkeeper, where you have 11 members of the other team throwing things at you, and sometimes you have your own team members throwing things at you. So one of the things which we request investors is to not react on a very ad hoc manner in a very quick fashion. Most of the mistakes that we make during investing are when we react very suddenly. And this is also because the reactions are driven by our psychology. There is so much psychology, and in fact, some people say biology in our brains that actually defines investing, that it's not funny. When we are faced with stress, it's the natural animal instinct that we have is to do something about it. Okay. Back in the day when we were animals in a jungle, or we were monkeys potentially, if you would see a lion, you would want to run. And that's the natural reaction that our brains have, is to react to every situation. In psychology, some people call this action bias, where you want to do something on a very active basis whenever faced with a new situation. Investing is exactly the opposite sometimes. It requires you to take a deep breath, step back, not react on that particular day, maybe not even the next day, maybe not even the next month. And sometimes just staying in is what really works out, or following the previous slide which I spoke about, which is your own investing discipline. Going back to what I was talking about in the COVID example, if you go back to March 20 and look at things today, COVID is still around. We still have more concerns or enough concerns about people losing their lives, but markets have moved on and life moves ahead. So that is where the point of not reacting very, very quickly really plays out for us. And a lot of successful investors don't react very, very often. Again, going back to Warren Buffett, he's held Coca-Cola stock from as long as probably 1980s. Okay, so that is what good investment is made up of. One of the other points is about managing risk when it comes to the portfolio. Again, we've met many successful entrepreneurs. Some of them have spoken on the last few sessions with all of you. And naturally, by instinct, entrepreneurship is about embracing risk. You would want to have situations where you are faced with opportunity, and no opportunity comes without a crisis. So in some sense, a lot of times entrepreneurs are also looking for risk which they can build to their advantage. They are still managing risk, but in a very different way. Investors need to manage risk as well. So how do investors manage risk? And what is the point that I'm trying to tell you here? Let's think of two very different companies. One, a very large, successful company, or a large cap stock, as it is called in equity parlance, and the other being a small cap company which is doing really well, but is still a small company. When we look at the potential returns that these companies will give, we have to include a concept of probability when thinking about this. What does that mean? So if the small cap company is likely to give me, say, 20% return, okay, and the large cap company is likely to give me 10% return, I have to think about what is the probability of each of these events happening. So if the small cap company has, say, 20% probability of giving me 20% return versus a large cap company having 50% probability of giving me 10% return, sometimes as investors, you will end up choosing the large cap company because the probability weighted output of that potentially can be more. And that's not to say that we should not invest in small caps. All I'm trying to say is that we have to evaluate the risk of every instrument or every decision that we make before jumping in. As entrepreneurs, you know that you're taking very different risks in your business. And sometimes, therefore, when it comes to the portfolio, you potentially don't need to take or don't want to take too much risk at all. This also goes to the whole philosophy of the fact that entrepreneurship is about wealth creation, whereas managing portfolios more often than not for majority of the investors is about wealth preservation. And therefore, when we are thinking about our money, managing risk on the money and eliminating risk as much as possible is as important as being excited about risk on my entrepreneurial ventures or the business that I run. The other part is about how you think about investments which you don't understand. And this is one of the areas where there has been a lot of material today. Fortunately, thanks to the internet, there is so much information available about every asset class, about every investment out there. A lot of participants in the financial domain are doing exciting work in laying out concepts in a very simple to understand manner. Earlier this year, again, when we had the COVID event, there was a lot of trading of futures and options that had begun very actively in the equity markets. And for the first time, we are seeing retail investors participate in futures and options. However, when you sometimes sit down with these investors and try and understand whether they know what they're doing, there is concern that potentially one is not fully familiar with what the outputs are. We saw earlier in this year a new generation of investors get created in the US, which we call the Robinhood investors. Robinhood is an exciting technology platform in the US which allows investors to or retail investors to do trading at very, very low cost. What did this do in 2020? A lot of these investors started playing futures and option strategies. And in many ways, it became a sense of competition, a sense of gambling that kicked in here. You're buying futures or options, even worse, of a stock, hoping that if the stock runs up, even by 1 or 2%, you will make a very large payout in the next 15-20 days. What happens when these kind of situations arise? We have to also look at what would have happened if the stock does not go up. And it is possible that all the money that I put into that strategy can get wiped off. And sometimes this is something that investors may not have realized. Regulators world over, especially in India, are very concerned about this. So SEBI, which is our regulator in India, has increased margin requirements for futures and options trading meaningfully over the last many years. And in doing this, they've been able to protect investors who are getting into these strategies without potentially fully knowing what they are going in for. Again, you will find this example when you're investing into early stage startups. Again, what you would see here is you're presented with an exciting opportunity. You put in your money. And while some of these early stage startups will do really, really well and add a lot of value to your portfolio, some of them may not. So when we are going into these strategies, we need to know that we need to, again, spread our bets across multiple startups as opposed to having all our money in one or two. And this therefore goes to the point that I'm trying to make here is, if we are not comfortable with investing into a particular instrument, it is all right not to go in for that particular opportunity. We've seen this in different aspects of investing, whether you call it structured instruments, whether you call it complex credit in the US. The last financial crisis in 2008 was again driven by complex derivative strategies on home mortgages and so on and so forth. So again, our advice to investors is, when we do not understand a particular strategy, it is okay that we don't go in for that. Let me put this in another way and tell you why it is okay to skip that strategy. Going back to my first point about diversification. Let's say you have decided that for every instrument, any instrument will not be more than 10% of your portfolio. What happens when you do that? You're saying that I'll have at least 10 instruments, and some instruments which I'm not sure of or I'm not fully comfortable with, I will potentially have only 5% of my portfolio in that instrument. With that, now let's look at the impact of that instrument. Let's say that you find a very exciting strategy which you are not fully sure about yourself, and don't know whether it will work out or not, and you still allocate 5% of your portfolio to that. So you have 20 things in your portfolio. One of those 20 things is this one strategy that you're not quite sure about whether will work or not. Let's say your portfolio has been delivering 10% return consistently over a period of time, and this one strategy gives you 20% returns. What is the impact that this strategy has on your portfolio? Is nothing but 20 multiplied by 5%, which is a 1% impact on your portfolio. So even if it works out really well, it will add 1% to your portfolio. And if it doesn't work out, you have potentially stand to lose as much as 5% of your overall portfolio. So again, the risk reward is not in your favor. And sometimes it therefore is all right not to do that particular investment. In investing, again, like in life, there is always the fear of missing out. But it is our advice, after having seen this with multiple investors, that if you don't understand something and you skip it, you're always better off in the long run. Because when the problem strikes, you don't know how to react, and then you would potentially may want to sell it too early or not see through that journey of that particular instrument. Moving on, and this is potentially one of the last few things I'll say about this before I get to some of the resources that I think you should look at, is this whole point of letting go. As an entrepreneur, your hand needs to be firmly on the wheel at all points of time. No leader of a business can say that I'm outsourcing an activity to somebody else, at least in the early stages of the business. You pretty much know what the OKRs of the business are. You know what you need to do on a daily basis. You come in and react to every individual situation onto the business on a daily basis. Sometimes this means that you're putting a disproportionate amount of time to your entrepreneurial venture. And that's absolutely right, because that's where you're going to create or become wealthy through. Now, let's think about the same thing in the context of investments. On a daily basis, as entrepreneurs, you're fully occupied with running your own business. You're responding to day-to-day challenges, emergencies, new people joining, new opportunities, people leaving. Those kind of things happen on a regular basis. So you're fully, your mind space is fully focused there. And when it comes to your time off, you obviously need to spend time with your families, etc. In this whole process, somewhere, managing the portfolio does potentially get neglected along the way. What do you need to do, therefore? Going back to my earlier messages, the first point is think about why you actually are saving, or what is the purpose of that saving. What is the diversification that you will have? What is the kind of investment policy that you will have? And what are the do's and don'ts that you will lay out for your portfolio? Once you've done that, it's sometimes not a bad idea to step back and let a professional take over from there, because the professional will also come at it from an unbiased perspective. Again, I'll give you 2020 example. Till last year, if I had done this session, I would have given you 2008 examples, but this is the strange thing about this year. We'll remember it for a very long time. Now, what happened in 2020? March 2020, the world was collapsing around us. Everyone knew that COVID is at its peak and the things are likely to get worse. And that was a time when equity markets took a very, very big knock. When the equity markets took a knock and you put things in perspective, you looked at equities, or what we call the Nifty, at 8,000 levels. It was very clear that from a valuation perspective, it was in a very, very attractive territory. Now, imagine if I, as an entrepreneur, on a day-to-day basis at that point of time, is fully focused on my business, reacting to the situations that are arising because of the lockdown and so on and so forth. It is possible that I may not have looked at that opportunity. That is one possibility. The second possibility is, not only was I not able to see the opportunity, even if I saw it, I was so occupied and so worried about what I was hearing and seeing around my business that I did not want to take a reaction on the portfolio side. Whereas now, if you look at a professional manager who was handling this part of your portfolio, what would he or she have done? You've given him or her a set of rules to follow. Under those rules, this person would have seen that there's an opportunity to buy into equities and would have pressed the trigger in a dispassionate manner. Sometimes when managing other people's money, it is easier to be unbiased rather than when you're managing your own money. Most of us wealth managers, therefore, sometimes don't manage our own money. We give it to another colleague or a wealth manager to manage for this very reason, that it is easy to get swayed by our own experiences, our own situations at that point of time, and then get colored by it. If you look at the generation prior to us, which actually went through the 1992 scams in the equity market, or the 2001 market correction, again partly because of technology bubble and partly because of what we saw in India in the, again, from a scam perspective, they got colored by that experience and thought that equities was a very, very risky and uncertain asset class. And can you blame them? You cannot, because that was the experience that they lived with. But if it were coming to a professional fund manager, if we allocate money to that person, the professional fund manager is required to follow the rules that have been laid out by the investor for them. And he or she then can be a little more dispassionate and take decisions which are in the long-term interest of the portfolio. What do you need to do as an investor? If you let go of your investments to a professional manager, you will potentially need to review that on a periodic basis and ensure that you have sight of what that person is doing. So letting go is something that we have seen very large, successful entrepreneurs do very well. We have multiple examples of, especially in the technology space, where some of our clients who've monetized equity and created wealth have given money to professional fund managers to manage while they continue to look at other opportunities of business that they will do. Remember, our part of the business, which is managing money, the difference between good and great can be only as much as a percent and a half. Whereas in your part of wealth creation, the difference between good and great can be multiples. So if you have limited time, where do you allocate that time? I think the answer is something that is very clear and apparent, at least to us. This is one point that has been the theme of this presentation today, that what it takes us to get to what we call rich, and again, it's being different things for different people, is very different from what it requires us to stay rich. Morgan Housel, who's, by the way, this book I would highly recommend, called Psychology of Money, writes very articulately about this fact that sometimes the best of entrepreneurs may not necessarily always be the best of investors, because staying rich or managing your money well requires a little bit of pessimism in the short term and the ability to ride through different situations which come along the way. Those are the few messages I have. Let me just check for the chat for any questions there. And yeah, so thanks for those questions. Yes. Now, the first one is, what are the learnings from managing money during the COVID era? Very interesting question, something that will potentially stay with us. This will be the story of a lot of books that will be written about this time. To my mind, one of the most clear thoughts that we have taken away is not to react very, very fast. And like I've said this before, if I were to do one thing different, what we did of 2020 is not to have reacted very, very fast during this time. Staying put, and thinking about the long-term potential of humanity is what managing money during COVID has taught us. We know now that the human race sees through different problems, has survived for a reason, and it will pretty much survive most calamities. Obviously, while we are going through those calamities, there will be challenges, but managing money during COVID has taught us to be a little more optimistic than we usually are. And the other question is around how should entrepreneurs who are just starting to accumulate money think about their portfolio? Again, interesting point. I would suggest that you should start small, start simple. There are simple instruments which are out there now, index funds or ETFs, which simply replicate the indices, where you do not need to do much. Simple things like mutual funds is what you need to start building your portfolio with. Frankly, the systematic investment plan is a concept that has held a lot of investors in good stead, and something that we would think you should continue working on. There's another question about how should we construct the portfolio and how much of the portfolio should be in stocks, bonds, or FDs. This is a question that we get on a daily basis. One of the most clear messages that we would like to give to investors here is that every portfolio is different. What works for me may not work for you, may not work for your friend. And why is that? Because every investor reacts very differently to volatility. Let's take an example of what happened in 2008, which was the last big global financial crisis. In 2008, somebody who had a very aggressive portfolio, and here I'll give the example of a very large bank, successful bank today, very well known. Back then as well, it was a very well known, well regarded Indian bank. The stock had fallen 90% in 2008. Since then, the stock has now gone up potentially 20-25 times from there. But the fact is that if even in a high quality instrument, you lose 90% of the value, it is natural at the bottom for any human being to react and sell out that particular portfolio. What does that mean? It means that different investors will have different tolerance for volatility, and therefore the portfolio that you construct for yourself should be something that is aligned to that volatility. You should be able to see through the investing journey, last through the investing journey, and to be able to do that, the portfolio should have that much risk as much as you're comfortable with having. So, to again put this in context, if let's say you had 100 rupees and you say that at no point of time will I want this money to go down, say below 90 rupees, then the amount of money you would put in equity will not be more than potentially 20, right? Because markets can go down by half. And if you put 20 rupees, it can go down by 10 rupees, whereas the other 80 rupees, which is the debt portion, will remain hopefully steady. So the answer is very different for each one of us, and we need to think through that and work with our advisors on that. There's another question about, are mutual funds a safer bet to invest in, or should we focus on gold and silver? A great question. Now, mutual funds come in different shapes and sizes. There are equity mutual funds, which invest into the equity markets. There are debt mutual funds, which invest into the fixed return markets and give you hopefully fixed return, though the last year especially has been unique because we've seen some problems around debt mutual funds also. There are balanced mutual funds which do a combination of equity and debt. So there are multiple types of mutual funds out there. And gold and silver are commodities which people buy as an inflation hedge, where you want to preserve the value of money, especially on the gold side. Now, how much should you allocate to, or should you do one versus the other? Again, going back to the point I made about diversification, potentially you need to have both of these asset classes or mutual funds as well as gold and silver in your portfolio. How much, again, should be guided by you. Typically, in the portfolios that we've seen been run by very successful investors, gold is an allocation between 3 to 5% of the portfolio, whereas the remaining is split across equity and debt, mutual funds, index funds, etc. And that's the construct that we recommend. But again, there is no one right answer. I would suggest that you should have mutual funds as well as gold as a part of your portfolio, not only focus on one. There's one advantage when it comes to gold is that some people in India also consider it as a proxy for the US dollar. It is one of the assets that provides us indirect exposure to the US dollar and therefore is a very useful diversification tool. Should we have a majority of our money in that? Maybe not. Should we have all of our money in that? Certainly not. But should we have some of our allocation there? We should have that. What are the safe investment avenues, FDs, PPFs, etc.? Yes, FDs and PPFs are relatively safer instruments compared to equities. However, there is one big challenge which investors are facing right now is the kind of low interest rates which are there in fixed deposits. And this is potentially a problem that is here to stay for some time, given that global central banks, Reserve Bank of India, the Federal Reserve in the US, are printing money on a very regular basis. Because of this, you're seeing a situation where the interest rate that we are getting on our bank deposits has been consistently falling for a reasonably long period of time. Therefore, should we have, again, all our money in fixed deposits? Maybe not. Then you may want to look at diversifying your portfolio. But if you want absolute safety of capital, then yes, fixed deposits of good large banks are the place to be. Again, here I would want to make one sort of important point, and especially relevant to entrepreneurs. There are times when we are managing not only our money, but the money for our corporate treasuries also. This is money that is a part of the company that we are running. Some bit of accumulated profit, sometimes some bit of positive working capital that has come. And where do we put that kind of money? Almost invariably, our recommendation on that portion of money would be not to take any risk at all in any form or manner. And this is important because it ensures that the money is available for your business when you need it. It is accessible for you. And when you need it, you don't have to look at the vagaries of equity markets and decide whether you should be using it at this point or not. So, money which is for the business certainly needs to be 100% secure, safe, fixed deposits, bank deposits, etc. What I have spoken about today is mostly for our personal part of the portfolio, which is outside the business and not something that we are going to use in the business. So those are the few thoughts from my side. For those of you who would like to continue this conversation, I would suggest you could email me at sandeep@iflw.com. I'm also happy to take questions on LinkedIn or Twitter. Respond pretty much very, very fast. We are still in the COVID era. We're all tired and exhausted, but continue to request everyone to stay safe and be careful. And there's one last point is about certain resources, which I would strongly recommend. I already told you about Psychology of Money. It's by Morgan Housel, available on Amazon. And there is this book by Monica Halan called Let's Talk Money. I've found it very useful in trying to understand concepts and explain it in a simple manner. Thank you. And again, congratulations to you guys for the journey that you're on of entrepreneurship, and to Ascent for such a phenomenal e-conclave yet again. Thank you, everyone.